Welcome to another Galileo monthly update. I'm joined today by Sherelee van Rooyen. Thanks for braving the camera work, Sherelee.
Always a pleasure, Warren.
So we're living in what they would call interesting times, and I think we're kind of getting quite a lot of questions from our clients. And as we prepare for this monthly update, we always try and distill the main themes of questions that we're getting from our clients. So I thought maybe we could go through those two or three main sort of topics that we're getting from them, and perhaps you can share with us maybe the first big one.
Yeah, so I think the first one that we really been addressing quite a bit lately is from our clients that have been retired for some time and that are obviously then drawing a monthly income from their capital. So the question there really is around why they aren't seeing the projected returns that they would expect on their investments. What is our take on that, and how would we address that in the months and years ahead for those particular clients?
Yeah, I think it's firstly, just to acknowledge it's frightening. If you're retired and all you've got is your capital, and what you've got on a monthly basis is outgoings, you've got expenses that you need to fund, and you haven't got a salary coming in on a monthly basis to cover those. It is a very uncomfortable place to be, especially when over a 5 or 8 year period, the returns that you're expecting are just not there. And so we need to be really sensitive to that for investors that are in that position really now, stressing about this, because we talk about the long term as 5 years and longer. So when you start talking about 5 and 8 years, we're in long term now. And I think we're very conscious of that. So I think maybe a couple of comments. One, historically, we're in an environment where interest rates have been incredibly low for South Africans and also for international investors. That whole cycle is reversing, both here and overseas. So for people who have debt, very uncomfortable when you have rising interest rates, because suddenly you've got more of an expense every month. But for people who are retired, and especially where their money is invested in retirement funds, rising interest rates become a good news story, because it means that the cash components of your portfolio, instead of generating 3 or 4% a year, start generating 5 or 6% a year, and potentially even 7 or 8 if interest rates really do start to rise. And at the same time, the bond component of those portfolios will go through a bit of price volatility. In other words, their prices might fall when interest rates start to rise, but there will be a time when prices will stabilize, and all of a sudden their bonds are generating an interest rate of 11 or 12% a year. And I think it's not far away from that now. So I think that diversification argument that we always have around investing is key now, because for people who are generating an income, the bond component is supposed to generate a predictable, fairly high level of income, where shares are supposed to give them growth. And that hasn't really been the case for the last while. So we're much more comfortable now that we think they will be generating income from bonds, and that will be a very nice stabilizer in the portfolios. And we also think that if you're used to this kind of low return environment that we've seen from equities, that's not going to sustain itself forever. The JSE, despite all the volatility, despite all the bad news around the world, the JSE hasn't collapsed like some of the international markets has. Yes, it's gone down, no question, but the demand for commodities in South Africa, the demand for resources, shares just generally around the world is still there. That's why we see the rand, every time things go bad around the world, we see the rand does fall, but the pressure is always for that rand to recover. So we're not kind of trying to peg false hope to our retired clients. We acknowledge that this is a difficult time, but we think that this will pass. And once the kind of noise is out of the markets, it might take to the end of this year, it might be early next year as well. We think that the income generating parts of the portfolios will start to play their role again. And we think that the capital growth from shares, both in South Africa and overseas, will kick in again. So we're asking for patience, and that's difficult to be patient when you're seeing money reducing all the time. But we believe that situation will reverse again. At the same time, we are in an environment where as inflation ticks up again, nominal returns will start to rise. Just to explain that. The growth of shares, we always measure the growth of shares versus inflation. If inflation is very low, then the growth of shares will be relatively lower as well. But if inflation starts to rise, then the growth of shares will rise accordingly. So it's important just to have a context to what's going on. When we projected, for example, a decade ago or 15 years ago, that shares would give you 13 or 15% a year, it was in the context of a much higher inflation environment. So now, if we're saying to you that shares could give you 11 or 12%, it's in the context of lower inflation. Even though inflation is rising somewhat, it's not going back to those levels of 10 or 15% that we saw 2 decades ago. So I think my message there, I know it's a mouthful, but I think it's an important point, is that we think the markets are normalizing again. We think that it's a strange situation to be in, where interest rates are sitting in South Africa at 4 or 5% for investors. It's not what we used to, or negative interest rates overseas. And so rates rising is actually a good sign. And we just need to get used to that situation again. Markets need to absorb the kind of bad news of rising rates, falling asset prices. Once they've got through that, they will start to price assets correctly, and we think that retired investors will generate a good level of income from their assets, and especially one that gives them protection against inflation.
Yeah, and I think it's just important to reiterate what Yolanda said last month as well, just around if there are any extra questions around this particular point, we're always here and available for clients to contact us. As you mentioned in the beginning, it is really scary, I think, for most of our clients right now, and even those clients that are just going into retirement, it's, I think, a little bit of a tricky one for them too, but we're always here and willing to answer any questions. I think the next question that most of our clients that have capital to invest at the moment, the question that they're really asking there is around should they be waiting to invest that money, and also why would we be phasing in the capital during the environment that we're in right now?
I must say that question resonates with me. I think I've had a few very pointed questions from our clients about exactly this point. So I think a few comments. One, it's important to understand that the drops that we're seeing in the world markets are largely driven out of the US market falling. So it's important to get a context from the US market when markets fall. What does that look like? So I did a bit of research, and looking at the US market, it falls by 10% or more every second year. That's the average. It falls by 30% in a year every 4 or 5 years. And so the context that we're in at the moment, it's fallen by about 20%, and when this goes out, it might have fallen by more, might have fallen by less. But just to understand that when we do investment growth projections for our clients, and we're anticipating what things are going to do over the next decade or 3, we're fully expecting the US market to fall by 10% every second year, and we're fully expecting it to fall by 30%. 30% is a massive number. If you've got $1 million invested, we're saying to you there will be a time when your $1 million is suddenly worth $700,000. It's a huge amount of money. And what we're saying to you is stay the course, because that situation will reverse itself, and you will still get the long-term growth from markets. So I think there just the point is that when we're phasing into a falling market, we would obviously love to be able to predict that the market's going to go from, let's say 100, and it will turn at exactly 62.2, and we're not going to invest until it hits 62.2, and then we'll get that recovery. If anybody in the world had that skill, they wouldn't share it with anybody. They would be sitting on a beach somewhere as multi-trillionaires. The reality is that we're talking about market timing, and unfortunately market timing is a very easy thing to do when you're looking in reverse, when you're looking in the rearview mirror. It's an impossible thing to do when you're actually investing money and doing it on a forward-looking basis. So those clients that get uncomfortable and irritated with us because we're phasing money in while they see their investments going down, we acknowledge again, we would love to be able to be market timers. We'd love to be able to tell you we can pick investment trusts or unit trusts or ETFs that can do that for you. The reality is no one can do it. There are going to be those few people that will be kind of broadcasting on a megaphone that they predicted this fall and they got it exactly right. The reality is they don't broadcast when they got that prediction wrong. So our view is we're looking to buy quality assets when those assets are trading at a discount to what we believe is their fair value. So if we believe an asset is worth 100 and it's now worth 80, we think it's a great time to be a buyer. The fact that we might buy it at 80 and then again a bit more at 70 and maybe a bit more at 60 is a reality. That's why we phase in, because no one can predict what markets can do. So I think it's important there to understand that when we put together an investment strategy and we start phasing in, it's because we know no one can get the market timing correct. And so phasing in, even though the markets are falling, we're very happy to own that share or that ETF or that investment trust at 80 and 70 and 60. We believe that by doing that, we're averaging that price down for you, and we're setting a great foundation for really good growth for the next decade or 2 or 3. And I think that that's the point about phasing in, is it's to try and average that price so that you get reasonably a fairly low price, and then you take advantage of a very nice recovery. We don't want to be a market timer where we say, okay, we believe now is the time. Let's take all your money and buy it, and the price is now 70, and then it collapses to 50. Because that's a huge loss. So we would rather be phasing in. And I think the other comment is it's difficult to do, but our suggestion to our clients and the job we have is to remind them that their time horizon is 2 or 3 decades. It's not 2 or 3 months. Contacting us to ask about performance over the last 2 months, it's just noise. Whatever happened over the last 2 months is hugely unsettling, I understand that, but actually over the next 2 decades, the last 2 months movement is going to be completely meaningless. And we tend to forget that. Our time horizons narrow very considerably when markets are going down and the news is bad. And it's our job there to remind our clients, and hopefully this conversation does that. You need to look further ahead. What we're doing today is buying new quality assets that will deliver returns over the next 2 or 3 decades. Yes, those assets might go down for another few months. We don't know. Just as easily, markets could turn very quickly if, I see Putin's going in for medical tests in the next little while. If he decides to pull out of the Ukraine conflict and we see the end of inflation in the US, markets could turn. We don't know when that will be, but it could be very quick.
I think the other point to just mention is around the scary news that we're seeing in the media, and I guess also just by fund managers and the like as well, where there's a lot of doom and gloom that's floating around at the moment. What's your take on that?
So let's talk about those. Are the analysts will call those forecasts. I think in plain language we call them predictions. If we analyze the predictions of global investment strategists, global economists, and we look at the accuracy of their forecasts or their predictions over decades, they are less accurate than a flip of a coin. You have more chance of being right if you flip a coin than that analyst who's highly paid, going to be very eloquent in their predictions, give you great arguments as to why they believe the world's going to fall apart or the world's going to recover. We've never given credence to those forecasts, even for rising markets. We don't get excited when analysts say, we think the market's going to jump 30% this year, because we believe they could just as easily be horribly wrong. So when markets are falling, we're equally going to ignore them because we think they have the same chance of being wrong as they have on the upside. And my comment there is you need to kind of filter the noise from the news. And valuable information is, what are the prices of quality assets? Can we put a value on those? Can we get to a value to say, we think it's worth 100, it's currently trading at 70, it's a good asset to buy. Yes, it might go down, but we're buying quality assets at such a discount that actually all the news and the noise is largely irrelevant to this conversation. And also, when we make an investment strategy for someone and we implement an investment strategy, we're not doing it based on what JP Morgan or Goldman Sachs or Piet Poggenpoel in Pretoria, whatever they're saying. We're ignoring that because we've built an investment strategy for someone in their life with their circumstances. So it's got proper diversification, which is the key in all of this. If you properly diversified, properly spread, both in South Africa and globally, across a range of asset classes and sectors, then these market drops are unsettling, but they're not going to cause a permanent destruction of capital. And I think that's the point here. Ignore the forecasts. All they do is create hype. They're designed to stimulate fear or greed. And so don't be part of the herd where you become a victim of the fear, because then they've achieved their objective. You've given them attention. They've got news. They're in the front page, or the top Twitter follower of the day, or whatever it is, the influencer of the day. None of that stuff's relevant. What's relevant is your strategy that's been built for you, and that's designed to kind of immunize you from the herd. We don't want you to be part of the herd. So if you're falling prey to the emotions that are being generated by forecasts, unfortunately you're going into the herd again, and the herd delivers really bad results for investors. So our whole strategy is built to take you out of that and to focus on a totally different set of objectives. And we don't worry about the forecasts in good times. Equally, we don't worry about the forecasts in bad times. Just to be very clear, that doesn't mean we're sitting here not worrying about what's going on in the global economy. Those are calculations and work and research work that we do as a business. And if we felt that we were going into an environment where shares would collapse for the next decade, we would have a different strategy. What we're saying is this market drop, we understand why it's dropped. We understand that financial physics have kicked in again. Money will have a value, both if you earn it on cash, or if you have to now borrow money, you will have to pay interest on that, especially overseas. Those are good reasons why the markets are down now. There's a lot of kind of fluff in the markets that has to get washed out of the system, but we haven't bought that stuff for people. We haven't bought the cryptocurrencies or the meme stocks and all of that stuff. So we're not worried about that stuff blowing up and causing huge headlines. We don't like watching a Microsoft, for example, which would be a core underlying holding for a lot of clients. We don't like to see that share price down. That doesn't mean we think Microsoft's going to fall apart. We think it's still going to be there, sitting on huge amounts of cash, selling more and more product to more and more people around the world. It's going to exist. So I think it's important just to have a long-term context when you see this stuff, and my suggestion is ignore it. It's just hype, and it's not there designed to help you implement your strategy.
Thank you, Warren. I think that's definitely going to provide some good context for clients to consider in the environment that we're in at the moment.
Thank you so much for braving the camera work.